Investing is a commitment to yourself and your financial goals. Start now and do not make excuses. If you have watched our video on why set financial goals, you are 50% more ready to invest than others. Planning for the future is not possible without you having a vision of what you want the future to be. Therefore, now that you know why you are investing, let's start discussing investment account options. Depending on your financial goal, we propose different investment accounts. If you are investing to put a down payment on a new car or a house, we suggest that you invest in an individual brokerage account, which allows you to transact in a variety of investments such as stocks, bonds, mutual funds, and exchange-traded funds. Keep in mind that you will have to pay capital gains taxes on any profit you make in the market, but it is the better option for a short to medium-term financial investment goal. If you are preparing to pay for your child's college expenses, 529 are tax advantage accounts designed for these types of savings. Recent changes have been made to 529 plans, making them even more attractive. For example, you can use 529 plans to pay for K-12 tuition fees up to $10,000 annually in a private, public, or religious school. You can add or remove 529 account beneficiaries anytime as long as they fall under the qualified family member category. You can also use it to pay for tuition, boarding, books, and supplies at any accredited college or graduate program in the U.S. or abroad. I was also surprised to learn that you can now convert unused 529 funds into Roth IRA savings, which you can use after retirement tax-free. Since we are talking about retirement, let's discuss the two main options. Employer-sponsored retirement plans, 401k or 402b plans, and self-directed brokerage plans, with traditional IRA or Roth IRA. Employer-sponsored 401k plans are retirement savings accounts that allow employees to contribute a portion of their salary, pre-tax or post-tax, into investments intended to grow over time for use in retirement. These plans are named after Section 401k of the U.S. Internal Revenue Code, which established them as a recognized financial instrument. They are a popular choice for retirement planning in the United States, owing to the tax advantages, employer contributions, and flexible investment options they offer. One of the key features of a 401k plan is its tax-deferred nature. In traditional 401k accounts, contributions are made using pre-tax dollars. This reduces the employee's taxable income for the year, providing immediate tax savings. Additionally, any earnings on the investments in the account, for example interest and dividends, grow without being taxed until withdrawal at retirement. This tax deferral can lead to significant growth over time, as compounding interest works on a larger balance without annual tax reductions. Employer-sponsored 401k plans often come with the added benefit of employer contributions. Many employers incentivize employee participation by matching a certain percentage of their contributions, effectively boosting the employee's savings rate. For example, an employer might match 50% of an employee's contributions up to 6% of their salary. This means that if the employee contributes 6%, the employer adds another 3%, enhancing the savings potential. Employer matching not only increases retirement savings, but also serves as a compelling incentive for employees to contribute, thereby fostering financial security. Participation in a 401k plan is typically straightforward, with employees choosing a percentage of their paycheck to allocate toward the plan. This amount is automatically deducted and deposited into the account, providing a convenient way to save consistently over time. Participants can select from a variety of investment options offered by their plan, including mutual funds, stocks, bonds, and money market accounts. These investment choices allow individuals to tailor their portfolio according to their risk tolerance and financial goals. For instance, younger employees with a longer investment horizon may opt for higher risk, higher reward options like stocks, while those nearing retirement might prefer more stable, lower risk investments. An important aspect of 401k plans is the annual contribution limit set by the IRS. For 2025, the standard limit for employee contributions is $20,500, with an additional $7,500 catch-up contribution allowed for individuals aged 50 and older. These limits ensure that participants do not exceed the allowed tax-advantaged savings amount. Employees must also be mindful of the vesting schedule for employer contributions. Vesting refers to the process by which employees gain ownership of the employer's contributions to their account over time. Some plans offer immediate vesting, while others may require several years of service before the contributions are fully owned by the employee. Withdrawals from 401k plans are subject to specific rules and potential penalties. Generally, funds can be withdrawn penalty-free after the age 59 and a half. Withdrawals taken before this age are often subject to a 10% early withdrawal penalty, in addition to ordinary income tax, unless exceptions such as financial hardship or other qualifying circumstances apply. Employer-sponsored 401k plans are also portable, allowing employees to move their funds between employers. When leaving a job, participants can roll over their 401k into another employer's plan, an individual retirement account, IRA, or maintain the existing account depending on the options available. This flexibility ensures that employees retain control over their retirement savings regardless of job changes. 403b plans, commonly known as tax-sheltered annuities, TSAs, are retirement savings plans specifically designed for employees of certain organizations, such as public schools, universities, religious institutions, and non-profit organizations. These plans are governed by Section 403b of the Internal Revenue Code and offer participants tax advantages to help them save for retirement. While they share many similarities with 401k plans, they also have unique features that cater to the needs of employees in the public and non-profit sectors. One of the defining features of 403b plans is their tax-advantaged nature. Participants can make contributions to their accounts using pre-tax dollars, which lowers their taxable income for the year and provides immediate tax savings. The investments within the account grow on a tax-deferred basis. Additionally, many 403b plans offer a Roth option, allowing participants to make contributions with after-tax income. While Roth contributions do not reduce taxable income at the time of contribution, they enable tax-free withdrawals in retirement, including the earnings. Employees can contribute a portion of their salary to a 403b plan through automatic payroll deductions, making it a convenient and consistent way to save. For year 2025, the standard contribution limit for 403b plans is $22,500, with an additional $7,500 catch-up contribution allowed for individuals aged 50 or older. Furthermore, a unique provision of 403b plans permits employees with 15 or more years of service with the same employer to make an additional catch-up contribution of up to $3,000 per year, subject to specific limits. This feature provides long-term employees with an enhanced opportunity to boost their retirement savings. Investment options in 403b plans have historically been limited to annuities and mutual funds. This restriction originated from the plan's early designation as a tax-sheltered annuity. However, modern 403b plans often include a wider range of investment options, such as exchange-traded funds, ETFs, and target date funds, which offer greater diversification and flexibility to participants. The available investment options may vary depending on the plan provider and the sponsoring organization. Employer contributions to 403b plans vary by organization, as nonprofits and public employers may have more limited resources for matching contributions compared to private sector employers offering 401k plans. However, some employers do provide matching contributions or discretionary contributions as part of their benefits package. Participants should review their plan's vesting schedule, which determines how long they must remain with the employer before gaining full ownership of the contributions. Withdrawals from 403b plans are generally subject to the same rules as those applied to 401k accounts. Although both accounts are tax-advantaged retirement savings plans with similar contribution limits and tax benefits, this distinction in eligibility based on the employer type is the key factor that sets them apart. Beyond this, the plans can differ in investment options, administrative costs, and additional features like special catch-up contributions for long-term employees in 403b plans. Traditional Individual Retirement Account, IRA, is a tax-advantaged savings account designed to help individuals save for retirement. Contributions to a traditional IRA are often tax-deductible, meaning they can reduce the individual's taxable income for the year of the contribution. The earnings within the account grow on a tax-deferred basis, which means that any interest, dividends, or capital gains are not taxed until the funds are withdrawn. This tax deferral allows for the potential of significant growth over time as investments compound without annual tax interference. Some people leverage traditional IRAs alongside their 401k accounts to build a retirement nest egg faster while minimizing their taxable income. Roth Individual Retirement Account, IRA, is a type of retirement savings account that offers tax advantages, particularly for those who anticipate being in a higher tax bracket during retirement. Contributions to a Roth IRA are made with after-tax income, meaning they do not reduce taxable income in the year of contribution. However, the key benefit is that qualified withdrawals in retirement, including both contributions and investment earnings, are entirely tax-free. To contribute to a Roth IRA, individuals must meet certain income requirements set by the IRS. For 2025, the annual contribution limit for IRAs is $6,500, with an additional $1,000 catch-up contribution allowed for individuals aged 50 or older. However, the ability to contribute to a Roth IRA phases out at higher income levels, depending on the individual's filing status. Roth IRAs provide significant flexibility regarding withdrawals. Because contributions are made with after-tax dollars, they can be withdrawn at any time without taxes or penalties, even before retirement. However, earnings on investments are subject to specific rules. To qualify for tax-free withdrawals of earnings, the account must have been open for at least 5 years, and the account holder must be at least 59.5 years old. Exceptions to these rules exist for certain situations, such as a first-time home purchase or qualified education expenses. Roth IRAs do not require required minimum distributions, RMDs, during the account holder's lifetime, allowing for continued tax-free growth. This feature makes them an attractive option for those who wish to leave assets to heirs. By offering tax-free growth, penalty-free access to contributions, and no RMDs, Roth IRAs are a flexible and powerful tool for retirement planning, particularly for individuals seeking long-term tax benefits and financial security. After choosing your investment account, now you get to choose your asset allocation. Choosing the right asset allocation for a financial portfolio involves balancing risk and reward to achieve your investment goals, while aligning with your financial situation and risk tolerance. Asset allocation refers to the distribution of investments among asset classes such as stocks, bonds, and cash equivalents. Each asset class has distinct characteristics, risks, and returns, making the selection process critical to building a successful portfolio. Assessing your risk tolerance is equally important. Risk tolerance is the level of variability in returns you are willing to accept. Let us know if you want us to make a video on risk tolerance. However, in summary, risk tolerance is how much of your money are you willing to lose. If your answer is none, then your risk tolerance is low, and if your answer was it depends on how much I could make, then your risk tolerance is higher. It is influenced by factors such as age, income, financial stability, and emotional comfort with market fluctuations. Conservative investors may prefer bonds and cash equivalents, while aggressive investors might favor stocks for their higher growth potential. Diversification is key to effective asset allocation, as it helps mitigate risk by spreading investments across various assets. For example, including international stocks or different bond types can reduce vulnerability to specific market events. Regularly rebalancing your portfolio ensures that it maintains your desired allocation percentages, especially as market fluctuations affect asset values over time. Always consult with a financial advisor or use a portfolio analysis tool to provide personalized recommendations based on your individual needs. Choosing the right investment strategy is the last step. Determine whether to invest on your own, use a robo-advisor, or work with a financial advisor, each offering unique benefits and considerations. Investing on your own requires a hands-on approach and is best suited for individuals who are confident in their knowledge of financial markets and investment principles. This approach provides complete control over decisions, enabling you to select specific assets such as stocks, bonds, mutual funds, or exchange-traded funds, ETFs. It often involves lower fees, as there is no need to pay for advisory services. However, self-directed investing demands time, research, and the ability to manage risks, which may be challenging for beginners or those with limited financial expertise. To succeed, it is essential to develop a clear strategy based on your goals, diversify your portfolio, and consistently monitor and adjust your investments as needed. Robo-advisors are automated platforms that create and manage investment portfolios using algorithms. These platforms are ideal for individuals who prefer a hands-off approach or are new to investing. By gathering information about your financial goals, risk tolerance, and time horizon through an online questionnaire, robo-advisors construct diversified portfolios tailored to your needs. They often use low-cost ETFs and automatically rebalance portfolios to maintain the desired allocation. Robo-advisors typically charge lower fees compared to traditional financial advisors, making them an attractive option for cost-conscious investors. However, they may lack the personalized advice or human interaction that some individuals value in managing complex financial situations. Financial advisors are professionals who provide personalized investment advice and financial planning services. They are well suited for individuals who require comprehensive guidance or have unique financial needs, such as estate planning, tax strategies, or managing significant wealth. Financial advisors can offer tailored recommendations, answer questions, and address concerns, making them particularly valuable for individuals who lack the time or confidence to invest independently. However, their expertise often comes with higher fees, either as a percentage of assets under management or a flat hourly rate. It is crucial to choose a reputable advisor and ensure their approach aligns with your goals and risk tolerance. Selecting the right approach depends on your level of financial knowledge, the complexity of your goals, and your willingness to engage with the investment process. Those seeking autonomy and cost savings may prefer investing on their own, while individuals seeking convenience and automation can benefit from robo-advisors. For those with complex financial situations or a desire for personalized advice, financial advisors offer a tailored solution. By understanding these options and aligning them with your objectives, you can build an effective investment strategy to achieve long-term financial success. Let us know if you have further questions on the topic and check out our other videos to learn more about how to become financially free.